What exactly is the Kiddie Tax? In a nutshell, it's a tax rule designed to prevent high-income parents from shifting investments and income to their children to avoid paying higher taxes themselves. Basically, the IRS says, nice try, but we saw that coming. Now, stay tuned for the end where I will share a Kiddie Tax horror story and explain a very unfair outcome of these rules that often impacts college students. The Kiddie Tax only applies to what the IRS calls unearned income. This isn't money from your child's paper route or babysitting gigs. That's earned income, and that is taxed at their own rates, just like an adult. What we're talking about here is income that comes from assets like interest, dividends, capital gains, income from certain types of trusts. If you opened a UGMA or UTMA custodial account for your child and they are making interest, dividends, or capital gains, you need to pay attention. Does your child have to pay taxes on their unearned income? Well, it depends. There's a sweet spot of earnings where they don't have to pay tax, but there is a painful threshold that, if they cross it, will make them pay tax on the earnings at your marginal tax bracket. Ouch. Let's explain the three key thresholds. Number one, the no tax zone, which is where we want to be. For 2025, the first $1,350 of unearned income for a child is tax-free. So if your child's only income is $1,000 in dividends, good news, no federal income tax on that. Number two, the child's rate zone. The next $1,350 of unearned income from $1,351 to $2,700 is taxed at the child's own tax rate. For most children, this will be the lowest federal income tax bracket, which is currently 10%. So if your child earns $2,000 in dividends, the first $1,350 is tax-free, and the remaining $650 is taxed at their 10% rate. Number three, the parents zone, which is the big one. Now, here's where the Kiddie Tax really kicks in. Any unearned income above $2,700 is taxed at the parent's marginal tax rate. That means if you're in the 24%, 32%, or even higher tax bracket, your child's unearned income above that $2,700 threshold will be taxed at your much higher rate, not their lower one. This is the core of the Kiddie Tax, preventing that tax avoidance we talked about earlier. So, to recap, for 2025, 0 to $1,350 tax-free, $1,351 to $2,700 taxed at the child's rate, above $2,700 taxed at the parent's rate, which is probably you. So, who exactly is considered a child for the Kiddie Tax? It's not just toddlers and elementary school kids. The rules are pretty specific and depend heavily on age and student status. The Kiddie Tax applies to children under age 18 at the end of the tax year. This one is pretty straightforward. It also applies to 18-year-olds at the end of the tax year unless their earned income is more than half of their support for the year. So if an 18-year-old is working full-time and supporting themselves, they might escape the Kiddie Tax based on that. Next, we've got children aged 19 to under 24 at the end of the tax year. If they are full-time students and their earned income is not more than half of their support for the year. So this is the big one for college students. Let's look at the college scenarios. Scenario number one, dependent college student. A full-time college student under 24, not self-supporting. If mom and dad are paying for tuition, housing, most of their expenses, and they have significant investment income, that Kiddie Tax will likely apply. Their unearned income above $2,700 will be taxed at the parent's rate. Scenario number two, a self-supporting college student. A full-time college student under 24 who is self-supporting. If they're working a job that covers more than half their support, even if they're a full-time student, the Kiddie Tax generally will not apply. Their unearned income will be taxed at their own rates. Now, it is important to remember that support includes things like food, lodging, education, medical care, and clothing. Calculating who provides more than half can sometimes be tricky. So if you're in a borderline situation, probably best to consult with a tax professional. Here's an administrative note. It's important to note that either the child or the parent can report this unearned income and pay the tax on it. As long as one of them reports it, they're being compliant with the law. Why is understanding the kiddie tax so important? To avoid nasty surprises. No one likes an unexpected tax bill. It is also very important for financial planning. If you're planning on gifting significant assets to your children or setting up investment accounts for them, you need to factor in the kiddie tax to understand the true tax implications. Here's a couple key planning considerations. Estate planning. The main benefit to giving your child a bunch of money to invest is that you will get it out of your taxable estate. But for this to be an actual benefit, you typically need a taxable estate of more than about $15 million. And if you're married filing jointly, that number goes to about $30 million. Number two, tax rate arbitrage. If you're in a high tax bracket and your child's investments generate just enough to stay under the kiddie tax threshold of $2,700 of unearned income, then you have achieved great tax rate arbitrage. Your child will pay much less tax on that unearned income than you would. Now, if you're debating between a 529 versus a custodial account, if you want to invest the money for your child's future, a custodial account like a UGMA or UTMA offers much more flexibility on how the funds can be used compared to a 529, which must be used for education. But remember, the 529's tax-deferred growth doesn't trigger the kiddie tax, the basis rule. If you gift your child money, they invest in stocks, they will not get a step up in basis on those stocks when you pass away. They would only get a step up in basis, which could save them thousands in capital gains tax, if they inherited those stocks from you upon your death. Another point to consider is financial aid. Gifting your child money to invest will work against them when it comes time to fill out the FAFSA student aid forms. Now, if you decide to open an investment account for your child, you can strategize your investments to avoid the penalty zone. And you can do this by focusing on growth. Consider investing in assets that do not generate much in the way of interest or dividends. If the investments are focused on growth stocks or ETFs that rarely pay dividends or make capital gains distributions, then you might be able to stay under the $2,700 threshold. Or think about waiting for an exit. In the event that your child's account has highly appreciated stock, you can consider waiting until the child meets one of the exceptions to the kiddie tax rules before selling that stock, such as waiting till they turn age 24 or they turn age 19 and are not a full-time student. They are age 18 to 23 and their earned income is more than half of their support. Those three exceptions would allow you to escape the kiddie tax. So here's the horror story that I promised, which demonstrates the real unfairness of this rule. A 21-year-old full-time college student was paying for her 2025 expenses via interest, dividends, scholarships, and help from an aunt. She had received a settlement years ago related to a car crash, which had been invested. Crucially, she had very minimal earned income, much less than half of her support. Her mom had passed away years ago, and her dad had never been in her life, but she knew he was alive. Based on all of these factors, she met the criteria to have to pay tax on her interest at her father's tax rate. She didn't even know her dad, much less his tax rate. To me, this is an infuriating result of the kiddie tax rules. We have a hardworking young woman trying to make it without any parental support, and she gets stuck with two options. Number one, lie on her tax return and say that she doesn't know if either one of her parents are alive. Or number two, get stuck paying tax at her dad's potentially higher rate that she does not even know. So for people in this situation, there should be an exception allowing the tax filer to state that the living parent is not in their life and hence they are not subject to this unfair parental rate. The kiddie tax can be complex, but by understanding these three thresholds and the age student rules for 2025, you'll be much better prepared. Remember, this applies to unearned income, so your child's babysitting money is generally safe. If you are planning to save for your child's college and you're trying to choose between a tax-free 529 plan and a more flexible custodial account, which one would you choose? Let me know in the comments, and I will see you in the next video.
Hey, my name is Arash. I help people create plans to pay less in taxes. Did you know if you like, subscribe, and comment on my videos, you will automatically save 10% in taxes? Okay, that's actually not true. Also, I need to let you know that none of this video should be taken as tax advice. However, I would love to give you individualized tax advice. All you have to do is schedule a consultation on my website, link below.